Hello, and thank you so much for tuning into today's video on Roth and pre-tax savings and what are the differences between the two. So we'll talk specifically about Roth inside of retirement plans. We will also discuss differences between Roth and retirement plans as well as inside of IRAs. My name is Chad Narani from BFSG. I am a retirement plan consultant. I work with plan sponsors and fiduciaries overseeing and managing their retirement plans from 401ks, 403bs, 457s, et cetera, across corporate, universities, and the municipal sector. Also presenting with me, I have Mike Albee. Mike, why don't you introduce yourself?
Thanks, Chad. Hi, everyone. I'm Mike Albee, a senior portfolio manager and certified financial planner with BFSG. I've been with BFSG for over a decade and working with clients to create a financial roadmap and ultimately help them reach their goals and objectives.
Yeah, thank you so much, Mike. So with that today, Mike and I will go back and forth to you throughout today's video, which will only be about 15 minutes, giving a really high level overview of the differences between pre-tax and Roth savings. So again, what are those, right? So again, the typical ways to save inside of a retirement plan or an IRA outside of a retirement plan. On the left-hand side, you have the most common or traditional pre-tax contributions. The benefits of this types of saving is that you pay no taxes today, which reduces your taxable income in the year that you save in this account. Your money also then grows tax deferred, right? Which means you didn't pay taxes originally. It's going to grow without any taxes. And then when you decide to take money out of your retirement plan or IRA, you'll pay taxes on the money at the time of withdrawal. So again, it just kind of like, instead of your paycheck from your employer where you pay taxes today, you save in your retirement plan or your IRA, and you take money from there, that becomes your new source of income, and you're going to pay taxes just as you would from your normal employer paycheck. So the other type of savings you have in retirement plans and IRAs is what we call after-tax Roth contributions. And so the big benefit of those, the big difference is, number one, you pay taxes today on those assets. So, in pre-tax, you get to defer that taxes. Today, you're going to pay all of your taxes based off whatever your normal ordinary income is this year. The next piece, though, is that all of that money after you pay taxes then grows tax-free for as long as you save in that account, including all earnings and growth. And then the last piece is that you pay no federal taxes when you withdraw that money at retirement, right? Again, you already paid taxes on this money. So you paid taxes, it's going to grow tax-free, and you get to take it out tax-free as well. So a couple things at the very bottom, there's a couple asterisks there, right? So these are not meant to be small little footnotes that nobody reads. These are meant to be kind of highlights that we're going to talk about. And we will actually harp on this a couple times throughout this video. The first one is we talked about paying taxes at the time of withdrawal or no taxes at the time of withdrawal, is that withdrawals prior to age 59 and a half may be subject to a 10% penalty plus income taxes if it's part of that pre-tax bucket, right? So something to keep in mind is that your retirement plans as well as your outside IRAs are meant to be retirement savings vehicles. And these tax incentives you're getting, either deferred taxes or tax-free growth for the Roth accounts, are really there, the government's way to reward you for saving for retirement. So should you kind of break that contract and need the money earlier, you might be subject to a penalty. And also depending on the state you live in, there might be actually state penalties as well. So definitely look at the tax code or talk to your accountant to see if any of those might apply before you decide to take money out prior to hitting that age 59 and a half. The other piece specific to the Roth side of this is that the withdrawals will be tax-free on both the contributions and your earnings, provided that the account's been open for at least 5 years. And you hit that age 59 and a half, or death or disability, right? Some of the more morbid reasons that you might be taking a distribution, or I guess your beneficiary is taking a distribution. So again, we'll get on that 5-year rule. We'll hit on that a little bit more later. But again, you're really just highlighting the two big differences between traditional pre-tax or after-tax Roth contributions. So now, if all things are equal, right? It's like, why would you choose one or the other? So again, all things being equal, I have a chart here, but let me get to the assumptions down below. Right, the assumptions here, assume they're in place for the entire time. This is about a 30-year working, retiring at about age 70, and then living into retirement. So annual salary, assuming $100,000 for the entire period. So of course, most people aren't making the same salary their entire life, right? Maybe you made less than that at one point, you eventually make more than that. Just say on average for the entire period, you made $100,000 for simplicity's sake in demonstrating this example. The next piece, your pre-tax annual deferral rate is about 10%. If you save Roth, instead, you'd only save 7.5%. Again, I'll get to that in just a moment, why that is different. Your contribution effective tax rate is 25% while you're saving into the plan. And then the third line, the withdrawal effective tax rate is exactly the same, right? 25%. So all things being equal, right? Same tax rate on the way in, same tax rate when you're in retirement, taking assets out. Let's assume you make an annual return on your money about 7% for the entire period, and you need to replace about 60% of your income, right? Like you might have Social Security, other assets and whatnot. This account is going to replace only 60% of your pre-retirement income. So that 10% pre-tax versus 7.5% Roth that I mentioned, why the difference for that? Well, if you think about how much you might be able to afford from your paycheck, assume you could only afford 10%. That would be $10,000 in this example from a $100,000 salary. Now, if you put that in a pre-tax bucket, you get to save 10% pre-tax. That means $10,000 gets withheld from your paycheck. That's what you kind of did not take as far as income's concerned, and all that money goes into your pre-tax account. Well, if you were to pay taxes on that amount, right, like you are going to in Roth, 25% tax rate means $2,500. So in your Roth bucket, if you could only afford to forego $10,000 in total earnings, what that means is that in the Roth bucket, you'd want to only save 7.5% or $7,500 because you're also going to pay taxes on all this money as well, which would get you approximately to that $10,000 threshold that we're talking about. So with that in mind, in that pre-tax bucket, you're saving $10,000 per year or 10% of that $100,000 salary. Starting at about age 41, and over the course of 30 years, that would grow with 7% annual earnings up to almost $1 million. And then say you start retirement, you need to take that 60% income replacement need out, but you're also going to pay 25% taxes on this money, right? 25% withdrawal rate. That money will last you until about age 96. Now, what's the difference if you save in the Roth bucket instead, right? So obviously $7,500 going into the account is less than $10,000. So the blue line is your Roth bucket. It would grow to less, only about $700,000. But you don't have to pay any taxes on the way out, right? So that money that was less in your total account would actually last you until the exact same day as that pre-tax bucket, right? Because again, you paid 25% on the way in, but all your growth, all your earnings, and all that money is tax-free on the way out. So it's going to last you a little bit longer than that pre-tax bucket would. So basically, if all things are equal, there's really no difference between pre-tax and Roth as far as your retirement savings are concerned.
Chad, that's, great in theory, but we know in life, all things are not equal. So what if taxes do vary at retirement?
Yeah, that's a great point, Mike. So let me get to that on the next slide here. So I think that at the end of the day, the decision to save in a traditional pre-tax bucket versus Roth all comes down to your expectations around tax rates. And do you think you're in a higher tax bracket today than you're going to be in retirement? Or do you think you're in a lower tax bracket today than you're going to be in retirement, right? That could come down to not only just like, what do you think, your income tax bracket is going to be, but what do you think is going to happen as far as tax rates from a governmental perspective? Are they going to lower or raise rates long-term? So some of those expectations and working with your accountant are definitely things that we'd advise. So for the sake of simplicity, again, let's use the same example, traditional versus Roth, but let's assume that your tax rate in retirement is higher. So again, I'm going to pull all of your attention onto the very bottom of the screen. Those same three lines, notice that the second line, annual salary across, is exactly the same as it was in the first scenario. So what's different here is the very third line, and only the first part, your withdrawal effective tax rate. Instead of 25% on the last slide, which is the same as your contribution tax rate, we're going to assume that it's 35% in this example, right? So again, you're only going to pay 25% taxes as money goes into the account. But if you take money out of the account, it's going to be a 35% tax bracket. So how does that look? So for the traditional pre-tax bucket, again, you only pay 25% on the way in, same salary, same savings, same everything. So again, that's going to grow to the exact same dollar amount, about $1 million. But on the way out, instead of only paying 25% taxes like the last example, you're going to instead pay 35% in taxes on this money as you take distributions. So instead of lasting until about age 96, it's only going to last you until around age 89. Now, what's the difference with that Roth bucket that we were talking about? So instead, you had only been saving 7.5% in your Roth account, and it got you, again, to that exact same about $700,000 in savings. And again, you paid 25% on all of your earnings as you saved into that Roth bucket on the way in. But on the way out, this Roth bucket is not subject to income taxes. So that increased rate of 35%, this Roth bucket doesn't have to worry about. So again, that Roth bucket lasts to the exact same amount, 20 or 96 years old, right? So again, At the end of the day, it could be the reverse, right? You could be in a higher tax bracket today than you're going to be in retirement, in which case, saving in the Roth account would not have been more beneficial. So again, it all comes down to your expectations on tax rates today versus your tax rate in retirement, and what you expect tax rates globally to be too, or at least nationally based on your savings. So thinking about that, what are some of the contribution rules that you need to think about? So again, getting into the contributions, limits are basically the same for traditional pre-tax and Roth contributions in a retirement plan. So the annual maximum for 2021, regardless of pre-tax or Roth, is $19,500. And then the next bullet down, if you're age 50 or older, you can actually save an additional what we call catch-up contributions of $6,500, bringing that total annual maximum up to $26,000 in savings. Now you can save $26,000 pre-tax, you could save $26,000 in the Roth bucket, or you could do a combination of the two, right? Maybe $10,000 to one, $10,000 to the other, or $16,000 to one, $10,000 to the other, whatever combination you want, except that the total amount cannot go above that $19,500 or $26,000 depending on your age. Then the very last bullet point on the page is that should your employer make matching contributions or a profit sharing contribution into your retirement account, all of those employer contributions, at least today, as of year 2021, employer contributions can only go in on a pre-tax basis, right? So even if you save 100% of the Roth bucket in your retirement account, any employer dollars that go in to match those dollars will go in pre-tax anyways. So from a tax perspective, it's actually probably a good thing. I think Mike will talk on this in a few slides. Really a good thing. You're going to have some pre-tax, some Roth money, no matter what, if your employer does save on your behalf as well. So let's highlight some of this and talk about why somebody might want to save in one bucket versus the other. So again, to summarize, pre-tax contributions, tax deductible today, your earnings compound on a tax deferred basis, and then that big bright blue bullet point, all of your withdrawals at retirement will be taxable. And again, that asterisk that we had, that withdrawals prior to age 59 and a half might be subject to a 10% penalty plus income taxes in that pre-tax bucket. So Mike, you work a lot with individuals in helping them manage their assets into and through retirement. What are some times that somebody might want to consider pre-tax contributions instead of Roth?
Yeah, so I mean, kind of like your example showed with the chart, typically you would favor pre-tax if you think your tax rate will be lower at retirement. So the opposite of what your chart showed. If you're a high earner, this is particularly appealing aspect of pre-tax accounts. So you'll likely be in a lower tax bracket when you retire. Furthermore, pre-tax deductions reduce the amount of income you have to pay taxes on. So again, that's another bonus for those high earners or others needing tax savings now.
Yeah, I like it. Thank you so much, Mike. So I think let's do the exact same thing for Roth then. So again, to summarize here, number one, not tax deductible today. So you will pay taxes on all of your income, and then save into the retirement account after tax. And then the next bullet point, qualified withdrawals are tax-free. And like we mentioned earlier, those kind of bullet points are the footnotes that we put, we're going to harp on a couple times. And so I broke it out a little bit here. So number one, the first Roth contribution to your account must be made at least 5 years prior to taking that first withdrawal. And not or, big bright red, and you must be at least age 59 and a half, or you become disabled or have passed away and the account's been transferred to your beneficiaries, right? So again, a little bit morbid to have a reason to get these assets out of the plan until you're age 59 and a half. So a huge big thing, first Roth contribution 5 years before. Now that 5-year window starts the day you make your first contribution. So I think you start in 2021. Doesn't matter if you made it in January or December of 2021. Really, it's January 1st of 2021 is the starting date. So if you make a contribution to your Roth account, the very first one on Christmas of 2021, technically all of 2021 will count towards that 5-year rule. So technically speaking, you'd be about 4 years of having money in the account because 2021 would count in as a whole. And then again, big bright blue, you don't have to worry about future tax rates, right? That's the absolute best benefit of these Roth savings. So again, Mike, thinking about individuals, when might somebody want to consider Roth contributions instead of pre-tax?
Yeah, so typically our clients consider a Roth if they believe their tax rates at retirement will be higher. And this often applies to younger clients with a long runway until retirement, who necessarily don't need tax savings today, but with expectations of future income growth, they're going to be the ones favoring Roth accounts. And there's also, but high earners could also favor Roth accounts because Roth IRAs do not have income limits, whereas in-plan Roth accounts, I apologize, Roth IRAs have income limits, whereas in-plan Roth accounts do not have income limits. So you can get around these limits with some backdoor Roth IRA contributions. Is a strategy that gets pretty complex, and we're not going to go into in detail today. But just note, in-plan Roth accounts in a retirement plan do not have income limits, and which is noted there on that last bullet point in italics. And you can go to that link for the income limits on Roth IRAs.
So Mike, in thinking about this, before we move on, is there any reason that somebody in a high tax bracket might want to save in their Roth account and even just pay those high tax rates today?
Yeah, Roth accounts really, I mean, they're an ideal wealth transfer vehicle for estate planning purposes. And the big reason why is because there's no required minimum distributions on Roth accounts. In-plan Roths do have that, but again, we'll talk later about a loophole where you can avoid those. But that's a big reason, is they're great wealth transfer vehicles. So if you're not needing the money and you're planning to transfer these assets to your heirs, then Roth accounts are great. The other thing is, and you touched on it briefly, Chad, is we recommend having both pre-tax and Roth accounts, because when you're at retirement, it opens you up to more levers to pull for tax bracket management. So if you start drawing on accounts and you're trying to manage the tax bracket you're in, that's great to be able to maybe take a little out of a Roth to stay within that tax bracket, and then some from the pre-tax. So again, it just gives you more flexibility, having both pre-tax and Roth contributions.
And so, what about, somebody retires, or maybe they leave their employer, right? What are some of the options they have, and do they vary between that pre-tax and that Roth bucket?
For sure, yeah, they do. So before we do that, I do, and again, Chad's talked about how we are going to be harping on this. We just want to go through the rules one last time about distributions from these accounts. So your in-plan Roth contributions are always tax-free when distributed from the account, but the investment earnings are tax-free only if they meet the definition of that qualified distribution. Again, a qualified distribution is met when you meet the age requirement of age 59 and a half, or in the event of disability or death, plus the 5-year waiting period requirement needs to be met. If it does not meet these requirements, then the investment earnings are subject to taxes and possibly a 10% penalty unless the exception applies, such as the age requirement. So with those rules covered, you have a few distribution options to be aware of. The first is cashing out in-plan Roth accounts, which is the first bullet point there. This is rarely a good idea unless your specific situation calls for this. The key is keeping your savings intact and benefiting from the tax-free growth. The second bullet point and second option really to consider is roll over your in-plan Roth to another employer-sponsored retirement plan that has an in-plan Roth feature. And today, that's much more common. You see approximately 65% of retirement plans today offer in-plan Roth accounts. And also note, the 5-year waiting period follows the in-plan Roth you roll over and doesn't start over. And finally, your last option is to roll over your in-plan Roth to a Roth IRA. You should weigh cost differentials of the in-plan versus the Roth and possibly any other fees you may be paying, but this is a nice option and maybe adds a little more flexibility as well. So with that said, there are some similarities and differences when looking at in-plan Roth accounts versus Roth IRAs. As previously mentioned, in-plan Roth accounts do not have income thresholds, whereas Roth IRAs have income limits. Another big difference is that in-plan Roth accounts have a required minimum distribution requirement. I mentioned that briefly before. You're required to start taking tax-free withdrawals from an in-plan Roth at age 72. Roth IRAs do not have this required minimum distribution requirement. So there's that loophole. So where you can roll over your in-plan Roth to a Roth IRA before age 72 and avoid that required minimum distribution. So discuss that strategy with your trusted professional if that's something that you may benefit from and applies to your situation. And finally, the 5-year requirement applies to both in-plan Roth accounts and Roth IRAs. But no, that clock starts actually ticking on January 1st of the year for which the contribution is first made. So if, say, for example, you make a contribution in December, that 5-year clock actually starts on January 1st of that year. So that's a nice benefit. And finally, you can make both in-plan Roth and Roth IRA contributions as long as the total amount is below the aggregate maximum contribution limit and you meet those income thresholds within the Roth IRA. So we both hope you enjoy this retirement readiness webcast on Roth and retirement plans. Our goals are helping you achieve a successful retirement. If you have any questions, please don't hesitate to reach out to our team of certified financial planners. Thanks for watching and have a great day.
Thank you so much, everyone.